Hello, my name is Joe Larkin. I'm from Denver, Colorado. This video is a brief overview of the sale-leaseback transaction and how many companies are uncovering their equity in their corporate real estate, utilizing the equity for operations, growth, expansion, and debt reduction. This overview on this strategy is focused on the features and benefits of the sale transaction to the occupier, the current owner of the building, that is considering selling their property and leasing it back. So who are the candidates for the sale-leaseback transaction? Well, there are many. In particular, single-tenant buildings such as manufacturing facilities, financial institution, corporate headquarters, office buildings, bank branches. There are a number of them. A lot of retail are real interested in the sale-leaseback transactions. Not too long ago, we had a company that sold brand new vehicles. It was a new car dealership, and also they sold used cars. The gentleman who owned the business was in the process of retiring. We had a buyer who wanted to buy just the business itself and not the real estate. So what we did was we partitioned the going concern, the business, and the real estate, selling the business to the person who wanted to run the dealership and selling the property in a sale-leaseback transaction to an investor who then signed a 20-year lease with this buyer of the dealership. It really is a great opportunity for people, companies that are looking to go into retirement mode and estate planning. So who buys them? Well, family offices, family trusts, syndicators, public and private equity, capital markets, real estate investment trusts, REITs, they also buy it. But the first thing you need to do is look at the non-financial issues before you start going into the financial analysis. Kind of want to go through the non-financial issues first and then do an overview of the financial analysis for the sale-leaseback strategy. So the first thing we need to do is explore with the occupier on how they make their decision to occupy their space. The four worlds of real estate are utilized in the decision-making process for many companies. We have the real world, which is the bank account and cash flows. We have the legal world, in particular the lease document. Many companies will make the decision on how that lease is drawn up. The third world is the accounting world, GAAP accounting. Many companies look at the impact to their financial statements. The accounting world can be different from the tax world. The tax world has to do with after-tax dollars and how much money is left over and what are the benefits of leasing versus owning the real estate. So we look at all four worlds of real estate, and many companies may be in one or two worlds. So what is the sale-leaseback strategy? A company, an occupier, sells its real estate to an investor that's unrelated to the occupier, maybe an institutional investor, and simultaneously signs a long-term lease, typically 20, 30 years long. The occupier receives cash, and the investor has a long-term financially sound tenant with a solid return. Typically, they're single-tenant buildings. So why should an owner-occupier implement the sale-leaseback strategy? Well, it's 100% financing. Conventional financing is typically 70%, 75% loan-to-value with a lot of closing costs. Also in the loan documents, you may have defeasance, you may have prepayment penalties, and things that could impede the operation of the business over time. It provides cash for operations, for a leveraged buyout, a merger and acquisition, to increase, expand the business, reduce shareholders, reduce debt. It can be used for many different things. It's access to long-term capital that actually is tied up in a non-core asset. If you think about it, if you purchased your real estate 15 years ago, more than likely the market value is not reflected on the balance sheet. The book value is. There is no mark to market. So it converts a long-term asset into a short-term asset in the balance sheet, improving the financial statements. The property is sold to an investor, and the real value of the asset, the cash now, reported on the financial statement, improving the balance sheet. So from the owner-occupier standpoint, the sale-leaseback transaction is really an attractive source of capital that can be used for debt reduction, buy back shares of stock, fund a merger and acquisition, an LBO. Also an opportunity to craft a long-term lease that could benefit the company over the next 10 to 20 years. aligning the lease and the real estate with the goals and strategies of the business itself. What are some of the performance measurements and financial analysis that we can use to help the occupier make an informed decision from a financial perspective? There are a few of them. First of all, the net present value after tax approach. Here we forecast out cash flows for the continue to own after tax, and also cash flows for the sale leaseback strategy, solve for net present value, and obviously the larger net present value would be the choice. We also look at the yield on the investment, and we compare the yield on an investment from an after-tax standpoint to their after-tax discount rate. We look at their weighted average cost of capital, cost of funds, or hurdle rate, and convert that to an after-tax discount rate and compare the two. Throughout all of the calculations, we're very sensitive in providing sensitivity analysis on all of our numbers. We come up with best case, worst case, most probable scenario, and we explain them to the occupier to help the occupier make a decision and where they think it's going to go with their business. Many businesses focus on the impact of the financial statements in GAAP accounting. We'll look at the GAAP accounting impact and how it will improve the balance sheet and financial statements. Another choice is financing. Remember, the sale leaseback strategy is 100% financing. Most conventional financing is about 70%, with a lot of closing costs and some loan covenants that could impede the operation of the business over time. So in summary, the benefits and use of funds for the occupier in implementing the sale leaseback strategy. First of all, cashing out the equity. It could be the opportune time right now. The market is peaked to sell your real estate. Also, it's 100% financing compared to conventional financing, which is typically 70% loan to value. Converts a long-term asset into a short-term asset. You have real estate a non-core asset, maybe not reflecting the true market value because there's no mark to market, and converting it into cash. So the real asset value now is being reported on the balance sheet, on the financial statements, improving the financial statements. Also, removal of any debt. If you happen to have a loan on your property, that has to be paid off. And if you think about it, the lease payment is 100% tax deductible. The use of funds. Well, there's a lot of purpose why you want to implement this strategy. First of all, you pay down your debt, increase your business and operations, buy back shares of stocks, reduce bond holders, fund a merger and acquisition, a leveraged buyout. But also one thing that I need to stress here is an opportunity to craft a beneficial lease that is in alignment with the goals and strategies of the company for the next 10 to 20 years. The sale leaseback strategy has many benefits for the occupier. Reviewing the subjective issues and also the financial issues and performance measurements is so critical. Also strategizing the lease document for the future operations for the next 10 to 20 years of the business, making sure that it is in alignment with the strategies and objectives of the company. I want to thank you for watching this video. Appreciate any emails, Joe_Larkin at Outlook, trustedreadvisor.com is my website, and also connect with me, Joseph Larkin, on LinkedIn.